Hello friends, how are you? I hope you all are doing good, and I hope all of you must have revised whatever we have covered so far. Right? We have covered material variances, labor variances, then variable overhead variances. So I hope all of you must have done the revision side by side, right? So let's continue with our discussion. Standard costing. So before we start, subscribe to the channel, press the bell icon so that you get all the notifications in time, right? And most importantly, share with lots and lots of people. Follow us on Instagram and Telegram. All the links are available in the video description. You can download our Android app also. That is going to be really useful because all the latest updates related to the new courses, the new test series, whatever is there, ebooks are there. So everything is available on the Android app. You can download the link. You can download from the link in the video description, right? Okay. So now let's continue with the standard costing. In standard costing, we have covered about material variances, we have covered about the labor variances, and in the last lecture, we covered about the variable overhead variances also, right? So in this lecture, we are going to start with fixed overhead variances. Fixed overhead variances. Now, these are a little bit technical, I will say, not that difficult. Not at all that difficult, a little bit technical, the fixed overhead variances. So listen to these variances very, very, very carefully, right? So as we discussed in the last lecture that when we talk about the overheads, right? Overheads we absorb on some basis. So in normally the basis will be labor hours. This is what we discussed that if we talk from the standard costing point of view, we say the overheads we have to absorb, right? We absorb on some basis, and the basis in most of the cases will be labor hours, right? So as we discussed that the variable overheads are absorbed, in the same way fixed overheads are also absorbed. Fixed overheads are also absorbed, right? And fixed overheads do not change with the level of activity. Do not change with level of activity. Right? Do not change with level of activity. So now we have to study about that how to study the variances. What will be the variances if we talk about the fixed overheads? Now fixed overheads are going to remain fixed, but we have to absorb them on some basis. The basis in normal case will be labor hours, right? So we'll see what we have studied till now. How we prepare. Let's talk about the variable overheads. How we prepared the table in case of variable overheads. How we have done the table preparation in case of variable overheads. We say standard hours for actual output, standard rate we calculate, then standard cost. Then we say actual hours, actual rate, and actual cost. This is what we have studied, whether we are talking about the material variances or we talk about the labor variances, or in the last lecture in variable overhead variances also we studied like this, right? If you see carefully that all these things we are talking about, if we talk about the standard hours, if you talk about this standard hours, and if you talk about this actual hours, this everything, standard cost, actual cost, everything we are talking from the point of actual output, right? The standards also we are calculating for actual output. Now, when you were setting the standards, originally when you were setting the standards, at that time, the standards must have been set for a standard output. Say you planned, what I'm saying is, listen to it very carefully. I'm saying you planned 100 units, right? Whereas the actual output is 110 units, right? The actual output is 110 units. Now, when we are preparing this table we are preparing according to 110 units. There is no reference to these 100 units. There is no reference at all that what was the original output that we planned for, what are the standards according to that. We haven't used anywhere, right? So there is absolutely no discussion on the standard output. Whenever we are starting with something, we always set some standards. Say you started studying, you always set some standards that in 3 hours I want to cover 5 chapters, right? Then in 3 hours you are able to cover 6 chapters. What we are doing is, we are first setting the standards for 6 chapters and comparing with the actual of 6 chapters. Then what about the 5 chapters, sir? The original output that we planned, 5 chapters or 100 units, where are they? Nowhere in our table, right? So, in fixed overhead variances, we are going to consider what we originally planned for. Why we consider this? Because the fixed overheads are going to remain same whether we are going to cover 100 units or 110 units. But where the difference will come? The difference will be the fixed overhead cost per unit will change. Say my fixed overheads are 1000 rupees. My fixed overheads are say 1000 rupees. Now, if you go by the planned one, if you go by this, what will be the fixed overhead cost per unit? What will be the fixed overhead cost per unit? That is 1000 divided by 100, 10 rupees. Now, if you go by this actual, the fixed overhead cost will be 1000 divided by 110, right? So 1000 divided by 110. This will be 9.09, right? So that is why it is important that we should consider the standard output also and the actual output also, because there will be a variance in the fixed cost per unit as per the standards and as per the actual output. That is why we are studying this. Now, in case of variable overheads, why we do not consider it? Because the variable overhead is going to change with the change in the level of activity. If you move from 100 to 110, the variable overhead will accordingly change. The variable overhead is not going to remain constant, right? But the fixed overheads are going to remain constant, but the fixed overhead cost per unit will change with the change in the output, right? So, what we are going to study in this one, in this we are going to study standard hours. We are going to consider standard hours. In fixed overhead variances, we are going to consider standard hours for standard output. Standard hours for standard output. Till now, we have studied about the standard hours for actual output. But now we are going to consider standard hours for standard output. Then we are going to consider standard cost planned according to standard cost planned according to standard output, right? Cost planned according to standard output, right? So when we talk about these standards, that is whatever the figure for the standards for standard output, whether we are talking about the standard hours or we are talking about the standard cost, when we talk about these hours or cost, we call them standard hours, standard cost for standard output, or we call these standards budgets, right? Budgets. Budget is something that you have planned on the past experience basis. So budgets, what is your budgeted hours for standard output? So we will write here as budgeted hours for standard output. Budgeted hours for standard output, and we will write budgeted cost for standard output. Till now we have been studying about the actual output, but now we are going to study about standard output. We write it as BH and B and C. Right? From here you can calculate the budgeted price also. The standard price, that is going to remain the same as we have already covered. So if we talk about the table, now if we are going to talk about the table, in table we are going to add 3 more columns, right? So here we will write budgeted hours, we will write budgeted hours, budgeted rate and budgeted cost. The standard rate and the budgeted rate, this will be same. It is one and the same thing, right? This will always be same. The only difference is the standard hours for the actual output and these budgeted hours are for the standard output. Clear? So this is a major difference in fixed overhead variances, that we consider the budgets. Budget means we consider the standards what we have set. We consider the standards what we have already set for the standard output. Now, as I told you in the last lecture also, that when we talk about standard hours for actual output and the standard cost, once again. So, when we talk about the standard hours and standard cost, we call this as absorbed overheads, right? This is my absorbed overheads. Right? These are my actual overheads and these are my budgeted overheads. Right? Now what we say, when we remember the overhead costing, we say first we calculate the budgeted overheads. On those bases we absorb the overheads. Right? Absorb overheads, we calculated the rate. Here we are calculating the rate. Budgeted overheads, we calculate the rate from here. On that basis, according to the actual output, we absorb the overheads on the actual output. So this becomes my absorbed overheads. And then we compare the absorbed overheads with the actual. Whatever the rate we calculated in the budgeted data, whatever the rate we calculated from the budgeted data, we use that rate, right, multiply it with the actual output, that becomes this absorbed. Clear? And then we compare the absorbed with the actual and try to find out the under absorption or over absorption of overheads. The same concept is here also. Right? So standard asks for actual output, standard cost. This becomes my absorbed overheads because this is on the basis of actual output. We are absorbing on the basis of actual output, then compare it with the actuals. The budgeted is from the standard output, whatever the budgeted rate we calculated, on that basis we absorb the overheads. Right? Now, let's see the first 3 variances. The first variance is fixed overhead. The first variance is fixed overhead cost variance. Cost variance. Right? So this is the first variance, that is fixed overhead cost variance. Now this remains as we have already studied, that is standard cost for actual output minus actual cost. Right? So as we have prepared this table, standard cost, okay, let's do one thing. Before that, let's prepare a clean table. Wait. Let's prepare a proper table first, then we will write down the formulas, right? So the table will be standard hours for actual output, standard rate, standard cost, actual hours, actual rate, actual cost. Then we have budgeted hours, budgeted rate and budgeted cost, right? Now we will write down. The first one is fixed overhead cost variance. Fixed overhead cost variance. So cost variance we are going to calculate from the actual output. Whatever is the absorbed cost variance means the absorbed cost, the difference between the variance between whatever you have absorbed and whatever is the actual cost, right? So it is, we can say, difference between difference between absorbed cost, difference between absorbed cost and actual cost, right? So this will be standard cost for actual output minus actual cost, right? So this is your formula for fixed overhead cost variance. Now, the next one, the second one. The second one is fixed overhead. The second is fixed overhead expenditure variance. Fixed overhead expenditure variance, or we call it as fixed overhead budget variance also. Budget variance. Now, this variance is what was the original expenditure that you planned for the standard output. What is the original expenditure that you planned for? What was your budgeted expenditure and what actually happened? So, difference between expenditure you planned originally, expenditure planned originally, we call them as budgets, because originally obviously we are setting as per the standard output only, right? And difference between expenditure planned originally and actual expenditure. Actual expenditure. So this comes out to budgeted cost minus actual cost, right? This becomes your fixed overhead expenditure variance, or it is also known as fixed overhead budget variance. That what is the original expenditure that you planned for and what is the actual expenditure that happened. In the cost variance, we say what is the cost that you have absorbed, the difference with the actual cost, right? Now, let's come to the third one. That is fixed overhead volume variance. Fixed overhead volume variance. Now, in this case, when we talk about the volume, this volume, we say this is the volume of output, right? So, what is the relevance of this in the fixed overhead variances? When we talk about the fixed overhead volume variance, what is the relevance of this? So there is a high relevance in this. What is the relevance? Listen to it very carefully. For example, say my budgeted overheads is say 10,000 rupees, right? And my budgeted output or the standard output, we call it as, right? It is also 10,000 rupees. So can you tell me the absorption rate from here? What will be the absorption rate? Can you calculate the absorption rate? Absorption rate is budgeted overheads divided by budgeted output. Overheads divided by output. This is what we have learned in the chapter of overheads. How to calculate the absorption rate, the budgeted overheads divided by the budgeted base. The base in this case is say I'm saying that it is output. So it is 1 rupee per unit, right? Now say that my actual output is not 10,000. The standards I set for 10,000, whereas my actual output is 8,000 only, right? My actual output is 8,000 only. Now tell me how much overheads you will be absorbing. What you will do, this absorption rate, you will multiply it with the actual output, right? So what will be your absorbed overheads? What will be your absorbed overheads? The absorbed overheads will be actual output 8,000 multiplied by 1 rupee per unit. That is 8,000 rupees. This is what you have absorbed. What you planned for 10,000. What you absorbed 8,000. So there is a variance due to the output. The output means volume, right? So there is a difference, there is a variance arising because my budgeted output was something else and my standard output is something else. Now in this case I have taken it on output, you can take it on hours also. Basically, the base will change, right? The base is going to change. So I planned for something, happened something, right? Absorption, we might take it on the basis of hours, right? Even if you are going to take it on hours, so you can take it on hours also. The same concept will remain the same, that there is a variance due to the variation in the output, right? Due to the variation in the output, that you planned something, you planned for the hours on the basis of budgeted output 10,000, whereas your actual output is 8,000. So your absorption of fixed overheads will vary, right? There will be a variance in the absorption from the planned one due to the difference in the output or difference in the volume. So from here, your formula will be derived. The formula here will be what is the absorbed overheads, standard hours for actual output minus budgeted hours, that is what you planned for, multiplied by standard rate. Clear? This will be the formula for volume variance. Clear, sir? This will be for volume variance, that what you originally planned for is budgeted hours, right? And for the actual output, what you have gained, this is absorbed. This is absorbed overheads minus budgeted overheads multiplied by standard rate. Now, why we are taking standard hours before the budgeted hours? Why don't we write budgeted hours minus standard hours? See, the absorbed, if the absorbed one is higher, it will be beneficial. If you are absorbing more than what you planned for, that means you are not at the loss. But if you are absorbing less than what you planned for, you are definitely at a loss. The remaining overheads which you have not absorbed in the finished goods, you will not be able to recover from your customer. You will be at a loss. You will have to bear that loss. But if you are absorbing more than the budgeted output, that means at least you are not at a loss. You are recovering more than what is required. That is a separate thing. That is over absorption. But at least you are not at a loss. Clear? So let's do one example on this. Whatever we have covered in this lecture, let's do an example on this. Budgeted fixed overheads. Budgeted fixed overheads. That is rupees 10 lakh. Right? After that, we'll say budgeted output. Budgeted output. This is standard output, 10,000 units. Standard hours per unit of output. Standard hours per unit of output. That is 10 hours. Clear? Actual overheads. Say rupees 10 lakh 50,000. Actual output. Actual output is 10,800 units. So this is the question, and you are required to calculate the fixed overhead cost variance, fixed overhead expenditure or the budget variance, and the fixed overhead volume variance. So these three things you need to calculate. So very simple. You will first prepare the table. Right, sir? That is the first thing that we have to do. That is standard hours for actual output, standard rate, standard cost. Right? Actual hours, actual rate, actual cost. Then we have the budgeted hours, budgeted rate, and the budgeted cost. Now, I'll give you a simple tip. Whenever you are starting with the fixed overhead variance question, always fill the budgeted part first, then the standard part, and then the actual part. Actual part will be given in most of the cases. So that is a separate thing, right? Whether you write actual first or the standard for actuals first. But always try to start with the budgeted data first. Until and unless the data is missing or something like that, the question is something like that, you have to calculate for the standards or actual first. Always try to start with the budgeted first. Now, what is my budgeted hours? My budgeted hours say for the standard output, what will be the hours, right? So in this case, tell me what is the standard output? Standard output is 10,000 units. So what will be the standard hours for standard output? Now standard hours for 1 unit is 10 hours. So what will be the standard hours for standard output? 10,000 multiplied by 10, that is 1 lakh. So this will be 1 lakh budgeted hours, right? How this 1 lakh? Sir, 10,000 is the standard output multiplied by 10. Clear? Next, what is given to you? Next given is budgeted fixed overheads, 10 lakh rupees. This is given. 10 lakh, this is given. So from here you can calculate easily the budgeted rate, right? So budgeted rate will be 10 lakh divided by 1 lakh. Right? After that, this budgeted rate, if this budgeted rate is 10, this standard rate will also be 10. Clear? Now, what is your actual output given to you? The actual output is given as 10,800 units. Now, we can set the standards for actual output. The standards will be for 1 unit, it is 10 hours. So, for how many hours for 10,800 units? This will come as 1,08,000 hours, right? 10,800 multiplied by 10. So, what will be your cost? Cost will be 10,80,000. What else is given to you? What else is given? We have used this. We have used this. What is actual overheads? 10,50,000. So I'll write here 10,50,000. Now the actual rate or the actual hours is not given. Let's say the actual rate is also 10. So actual hours will be 1,05,000. Right? The relevance is not there for the actual hours and actual rate. That is why it is not given. We suppose that actual rate is also 10. The actual hours will be 1,05,000. So this is the table that you need to prepare. So always try to start with the budgeted part, right? For the standard output, whatever is there. So always try to start with the budgeted part, then shift to the standard part, and then fill the actual part. Budgeted is whatever is my budgeted hours for the budgeted output. Budgeted output is 10,000 units. For those 10,000 units, what are the standards? 10 hours for 1 unit. For 10,000 units, 1 lakh hours. Overheads are given 10 lakh. Right? So from here you can calculate rate. Simple. So now you need to calculate the variances. The first one is fixed overhead cost variance. That is standard cost. That is standard cost for actual output 10,80,000 minus actual cost, that is 10,50,000. So it is favorable, 30,000 favorable. The next one is fixed overhead expenditure variance or the budget variance, that is budgeted cost minus actual cost. My budgeted cost is 10 lakh, whereas my actual cost is 10 lakh 50,000. So this is 50,000 adverse. 50,000 adverse. Now come to the volume variance. Fixed overhead volume variance, that is standard hours for actual output minus budgeted hours multiplied by standard rate. So what is my standard hours for actual output? That is 1,08,000. What is my budgeted hours? 1 lakh multiplied by 10. Now I have absorbed 1,08,000 hours, whereas the budgeted was 1 lakh. So that is a benefit for me, right? This 80,000 is favorable. I am absorbing more than what I planned for, so at least I am not at a loss. So from here we can say one thing, that fixed overhead cost variance is equal to fixed overhead expenditure variance plus fixed overhead volume variance, right? So cost variance is 30,000 favorable and expenditure variance is 50,000 adverse plus volume variance is 80,000 favorable. So net effect of this will be 30,000 favorable, right? So you can cross verify your question like this. So this is about the fixed overhead variances. We have just discussed 3 variances, right? We have to discuss more. We have to discuss about the efficiency variance, then we have to discuss about the capacity variance, then we have to discuss about calendar variance, revised capacity variance. So all these variances are still there to be discussed, which we will discuss in the next lecture. Revise it thoroughly, whatever I have told you. If you are not able to understand anything, just go through the lecture twice or thrice. You will be able to understand, and try to link it with overhead costing. So overhead costing should be clear. Before you study this chapter, your overhead costing concept should be clear, right? So study overhead costing before you move on to this standard costing. You will be able to better understand the things, that what is absorption, how we are taking the absorbed overheads, how we are comparing with the actuals, or how we are setting the budgets, right? So we are done with this. For this lecture, we are done with overhead, this fixed overheads. And in the next lecture, we are going to continue with the fixed overhead variances only. So next lecture, we are going to continue with fixed overhead variances only. After that, sir, is the chapter complete with the fixed overhead variances? After that, we'll spend just one chapter on the sales variances. In the ICAI module, that is for the CA students, the sales variances are not there, right? But for CMA students and the other courses students, the sales variances might be there, right? In CMA, there are sales variances, but in CA course, they have removed the sales variances, right? So for the CA students, the chapter will finish with the fixed overhead variances, okay? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep sharing, keep studying. Thank you so much.